Okay, let me jump in now to the main stuff here. I'll get going. Okay, chapter 1 is on capitalism, profits, and entrepreneurship. So the first fallacy so the way these lectures are going to work is I will just boom, boom, boom go through a bunch of fallacies related to the material that's covered in each of these chapters. Okay, so first fallacy here is that capitalism is a system that serves only the capitalist. So I don't know if you guys all know this, but the very term capitalism was coined by critics of the system, right? So Karl Marx and other Marxists early on used that term. So think of it. Capitalism is opposed to socialism. That they're trying to say capitalism is an economic system that favors the owners of capital, i.e. the capitalists, whereas socialism favors society. So with that very terminology, it seems as if it's clear they're loading the deck against capitalism just by the very choice of the term. However, Ludwig von Mises said, actually, ironically, this is a good term for it, and that's why he liked it. Because he said that the preeminent feature of the market economy is that it allows for economic calculation, and that ultimately means the notion of capital, and that it's also the capitalists who provide the engine of growth in a market economy. Right? So Mises thought that actually he didn't mind using the term capitalism, that was a good way to describe the market economy. Where he disagreed, of course, was to say that, the capitalist system is designed to serve the capitalist. He actually believed, and I agree with him, that market forces lead the entrepreneur to serve the interests of the consumers. And we'll probably hit on that a little bit more. Okay, another fallacy. Laissez-faire means no regulation. Okay, so the one standard way that they paraphrase the phrase laissez-faire, obviously from the French, is to say hands off. Okay, that what people mean by laissez-faire capitalism is that the government just lets anything happen, and so it's a fallacy to assume, therefore, that means there's no regulation whatsoever, there's no oversight, or there are no rules. That actually there's all sorts of things that would come into play. It's just there wouldn't be government-imposed regulation. Okay, so we'll hit specific examples as we go on, but just at this point, I just want to make sure we're all thinking about this properly, that don't fall for some of these standard fallacies to assume that if you have laissez-faire, it means you have no regulation. So in particular, as an economist, I wouldn't say, I'm against regulations on business. I would be, or at least if the context were possibly vague, instead I would say, I don't want the state imposing regulations on business, but certainly, for example, let's say an insurance company is providing fire insurance for a big skyscraper, right? So the owners of the skyscraper go to a big insurance company and say, hey, we want to take out policies in case there's fire in the building, then you compensate us for the damage. So maybe the insurance company then says, okay, we will do that, but there's a couple of requirements. For one thing, you're going to pay us monthly premiums to keep your insurance policy in force, but also you're going to agree to install a sprinkler system so that if a fire breaks out somewhere, somebody's smoking and throws his cigarette in the garbage can and a little fire breaks out in the wastebasket, you have smoke alarms and sensors and things, and then a sprinkler system kicks on so that the fire doesn't spread. That if we're going to insure your whole building here, it's in our interest to nip fires in the bud, and it makes a lot of sense to spend money up front to contain little fires so they don't spread. And so that's, if you want us to insure you, we require that. And then perhaps even beyond that, we reserve the right, according to this contract we're going to have you sign with us, you being the owners of the skyscraper and we being the representatives of the fire insurance company. This is a huge skyscraper, and even though you might agree on paper that you're going to maintain this sprinkler system, we want to check on you, and we're not going to just show up every 3 months and let you know we're coming, because then of course you'll get ready beforehand. We want to make sure that in general you're doing a good job to make sure the smoke alarms are always having the batteries replaced, and that the sprinkler system works, and that the fire extinguishers that are placed, on every floor are periodically checked to make sure they have enough stuff in them. And so we're going to randomly send our people into your building undercover to go check that stuff. And again, so this contract is allowing us the freedom to do that. Otherwise, we're not giving you a policy because we're on the hook for hundreds of millions of dollars of possible damages if there's a big fire. And so that's what we insist on. So that's kind of like outside inspectors coming in, and then maybe even part of the contract says if we discover a violation and you have smoke alarms on the 14th floor of your building that the batteries are all out of juice and the smoke alarms don't work on it, when we test you, we're going to fine you $5,000 per smoke alarm. That's part of the contract. So notice that feels very much like a government agency coming in, like OSHA or something, and finding workplace violations of safety standards, but it would be a private company. Okay, so that looks like regulating business and making sure they don't do something very foolish in the short run at the expense of long-term safety, but ultimately that all falls under the profit and loss test. So the difference is when there's what you could call private regulation, there's tendencies for it to make sense. That the fire insurance company, and that's an example we just went through, they would have no reason to insist on really silly bureaucratic things that serve no purpose. They wouldn't have the company file all sorts of paperwork verifying that they had checked the fire alarms and that they had checked the sprinkler system. It would just mean things that were rational that you really needed to do to make sure the system was in operation, because there's no reason that the fire insurance company doesn't benefit by needlessly burdening its customers. Whereas a government agency, if OSHA or whoever imposes all sorts of regulations that are kind of silly, they don't really do anything, they don't achieve the stated purpose, there's no feedback mechanism. It's not like the companies can fire OSHA and go get another regulator, whereas there are multiple fire insurance companies, and so if one of them had really unnecessarily draconian requirements, people who own skyscrapers would just go elsewhere. Okay, oops, I think I did. Hang on a second here. Yep, I skipped one. Okay, last fallacy from this chapter. The claim that society must choose between rational planning, by which they mean planning by the government, versus the anarchy of production, or the anarchy of the market. Okay, so again, the very word planning, it's not so much in vogue now, but back when, like in the early 20th century, people would use that word planning to mean government planning, because they thought that this would bring the age of enlightenment and scientific reasoning. They thought, well, instead of just letting the market produce things according to the profit and loss test, which seems kind of arbitrary, instead we should have experts get together and figure out the best way to use society's resources for the good of society. Right? So it seems kind of crazy, they thought, to, why is it that we have so many luxury automobiles being produced and yet there are people who are homeless? That seems crazy. Or why don't we have more drying machines, dryers, washers, and dryers being produced for real poor households that don't have them and have to go to a laundromat, instead of having those same resources getting put into like the third and fourth luxury automobile for some rich household that doesn't really need it. Okay, so that was the mentality, and so the point is that's a fallacy, that there is planning in the free market. It's that the planning is done by individual households and entrepreneurs and workers too, in the sense that they plan their career and decide, should I work here or should I apply for a different job? So the question is not, should there be rational deliberation and careful consideration before resources are deployed? The question rather is, should some group of self-anointed experts who have the power of the government's guns behind them be the one to impose their plans on the rest of society? That's what the choice is. So it's not planning versus chaos. So anarchy here being used in the pejorative sense. Okay, now we're on to chapter 2, which is called The Price is Right. Oops. Sorry. The Price is Right. So the first fallacy here is we're running out of oil. We need to switch to renewables. Now, I was recently at Mises University, and so if you want to see me spend 10 minutes on this one point, you can go look up my lecture, which at some point will be posted on energy policy. It'll be at the Mises.org website. But for right now, let me just give you the real quick version. So this is a standard claim that we're running out of oil or natural gas, or just more generally, finite fossil fuels or depletable fuels, and that's why the government should come in and impose all sorts of incentives and regulations to get people to switch to electric cars and things like that use so-called renewable energy. So here, what this overlooks is the fact that the amount of oil, for example, let's deal with oil, that people know about on planet Earth that can be recovered and used in production, that is not just some outside fact of nature. That amount of oil that humans have located is itself an economic question. And so if you chart the number of years left of oil reserves and look at that chart over time, it bounces around and actually is higher now than it was like in the year 1935, let's say. Okay, so let me just say that again. We humans have located more oil reserves and know about in the ground, and possibly under, in the ground meaning under the ocean as well. Humans know about more oil resources now, or reserves now, than they did many decades ago. And that, at first, that sounds counterintuitive, because if you think, well, no, there's just a fixed amount of oil, and every time we burn a barrel, that's one barrel less. What are you talking about? Because it's not like we make more barrels of oil. That's true, but that's not the issue. The issue is how much oil have humans gone out and discovered, and they know where it is, and they can dig a well and bring it to the surface if they want to. And so that's a separate question. And how do we find that stuff? Well, that's an economic issue. They have to send out geologists and other kinds of experts to go look for more oil reserves. All right, and so as humanity's annual consumption of oil has gone up, that puts more pressure. It increases the demand for oil. That increases prices, and so that gives more of an incentive for oil companies and governments to go find more oil. Okay, so the analogy I like to use is, it's like a little kid opens up the pantry and sees that they've only got 3 rolls of toilet paper left. And then he watches his household for a couple days and realizes that his family goes through a half a roll of toilet paper every day. And so he goes, oh my gosh, you guys, we're going to run out of toilet paper in 6 days. So that means, let's start using both sides. We got to conserve, really limit yourself. Let's stop eating so much stuff that's high in fiber, because we got to really conserve toilet paper here. And that's crazy. His mom or dad would explain, no, Jimmy, when we see that there's one more roll left, we'll go to the store and buy more. That what you're seeing in the pantry is just a buffer. It's like a warehouse, so that we don't just run out of toilet paper and have to go without. That we periodically go to the store and get a bunch more and then store it in the pantry at the house to give ourselves a cushion, a margin of error. Because we don't know exactly the rate at which we're going to use it up. But what we do is, when we see that the amount in the pantry is getting low, then we go to the store and get more. So it's the same type of thing with oil. As the amount of oil that we know about starts dwindling, oil companies go get more. And not because they're altruists, but because that's going to push up the price of oil, and so it makes sense to go get more. Oops, sorry, I'll get the hang of this thing eventually, don't worry. If I press one thing, it skips to the next slide. That's what the issue is. Okay, the next fallacy. Rent control helps poor tenants find affordable housing. Okay, so this is just one particular example. So rent control is when the government comes in and puts a maximum price on what an apartment can sell for. And so the problem here is, so obviously, prima facie, it looks like that's going to help poor tenants, right? Oh, instead of if the supply and demand curve intersected at $1,000 a month, that's the price that would balance supply and demand of apartment units in some urban area. And then the government comes along and says, no, it's illegal to charge more than $800. Well, now the legal price is going to be 800, and that's what most landlords are going to charge, because it's kind of hard for them to evade the law. That the tenant would just go tattle to the government and rat them out. Okay, so it seems like, oh, that's just a gift of $200 a month from the greedy landlords to the poor tenants, and so most people support that. But there's a bunch of unintended consequences flowing from that. So in the interest of brevity, I'll just go through this pretty quickly, because there's a bunch of other points I want to make, but just so you get some of the main points here. The most obvious problem is it causes an immediate shortage of housing. That if, using my numbers, if $1,000 a month for an apartment was what balanced supply and demand, then that means at $800 a month, now suppliers don't want to bring as many units to market. And since it's cheaper now, that means more people are trying to find an apartment. Okay, so especially when you think about it in terms of a big city, that at $800 a month, there are lots of people who are now willing to try to get their own apartment, whereas when it was $1,000 a month, some of those people said, wow, that's just too expensive. I'm going to split an apartment with my buddy, or I'm going to live at home for another year and save up money or something like that. Okay, but now if the rent falls from 1,000 to 800, there are more people in the aggregate who want to go rent a unit by themselves. Okay, so the total quantity demanded of apartment units is higher. On the other hand, there are some owners who withdraw their rooms from the rental market. And this doesn't mean sometimes people get confused and they say, well, wait a minute. In the short run, at least, imposing rent control is not going to make a building disappear. If there's an apartment building with 1,000 units in it that could be rented out, and the government, and right now they're all renting for $1,000 a unit, and the government comes along and reduces the price to $800, well, it's not like the owners of that are going to just detonate the building and put up a movie theater. What are you talking about? They're still going to rent it out. Well, possibly they'll rent out that particular, a situation like that, but the rental market does not consist only of dedicated buildings that are just for apartments, especially in a big city. Like when I went to NYU as a grad student, I stayed in places that, for example, like this one girl owned this whole studio, and then she rented me out a little bedroom for, I don't remember how much, a few $100s a month. Okay, and so if she were only legally allowed to charge me $50 a month, she wouldn't have done that. She just would have left that room vacant. She would have stored, her clothes or something in there. She would have put a couch in there and made it a TV room or something. But instead, she made a few extra $100s a month by having me stay there. Okay, so there's things like that. So that became all of a sudden a bedroom available for rent that would not exist if rent control had been applied to that particular unit. And there's plenty of cases like where I stayed. These people in Queens had a house, and they rented me out the bedroom. That was a little side thing. And again, I think that was like $450 a month. If they had only been allowed to charge $100, it wouldn't have been worth their time, right? Because there's a chance I could have been a thief. I could have ransacked their stuff and robbed them when they weren't home. There's problems like, maybe I have hooligan friends that would come over. Maybe I would trash the place. So there's risks to bringing in an outside tenant, and you're not going to do that unless there's a sufficient amount of money. So put those two things together. I hope what I've said seems reasonable. Okay, so that means as you lower the price, more people are going to try to go find apartments at that lower price, but fewer people are going to be willing to rent out rooms to tenants. And so if the original market clearing price was the one that balanced the quantity supplied and demanded, well, then that means at a lower price, there are more people trying to find apartments than can find them. And so there's a permanent group of people now who can't find housing, and they get frustrated. Okay, and so that's why in major urban areas, or at least that's a big part of the reason it's such a pain in the neck to move. So when you're at New York, you have to do all sorts of things to get a new apartment. You have to pay broker's fees. You have to know somebody. And that's largely driven by rent control. Whereas if you have the money and you want to buy a new plasma screen TV, it's not like you need to know somebody who works at Best Buy to hook you up. No, you just walk into Best Buy and say, I have this money. What's the price? Let's go, and put it in my car today, right now. Whereas, it's a long, laborious process to try to find an apartment when there's rent control in place. Okay, chapter 3, labor pains. So I'm going to whip through some of these because I want to leave your time for questions here. So the fallacy. In a just society, teachers would make more than star athletes. So you hear this a lot whenever some athlete, at least this happens in the United States. I don't know if this is true in other countries. But here, when some athlete signs like a multi-million dollar contract, people will often remark and say, that guy's making $2 million for throwing a white ball really fast at a catcher, whereas, our kids can't read and we got to pay teachers more, right? So there's lots of stuff wrong with it. The fundamental fallacy there is it's called, you have to think on the margin. And so it's the same principle as to why a pound of diamonds is more valuable than a pound of water, even though water is essential to life and diamonds are just a luxury item. If all the diamonds disappeared tomorrow, it wouldn't really be that big a deal in the grand scheme of things. If all the water disappeared, we would all die of thirst pretty soon. So there's a sense in which diamonds are essential for life, diamonds are not, and yet a unit of diamonds has a much higher market value than a unit of water. And so if you think through why is that, it's not because our society is evil, it's just because the supply of water relative to our uses for it is really big. So on the margin, if a particular gallon of water were to disappear, doesn't matter. We have enough water left to satisfy our needs or our desires for it. Whereas with diamonds, it's not like that. If a pound, if you had a gallon jug full of diamonds and someone accidentally dropped it in acid and it disappeared, you would be horrified. Oh my gosh, we could have used those. We could have made a bunch of rings with that would have made all sorts of people really happy. Okay, so that's the distinction, and it's the same applied to human labor. That on the margin, a starting pitcher, his labor services are more valuable on the market than any particular third grade teacher's ability to teach English or to teach addition to kids. That it's not that hard. It's not that scarce, the ability to teach third grade stuff to kids. Whereas the ability to throw 105 mile per hour fastball, that's a pretty scarce item. And that's why it commands such a high price on the market. What's ironic is a lot of the people who make this complaint are also the very same people who will warn us, just because somebody's rich, don't think that he's a good person. That doesn't mean anything. So let's not revere the lifestyles of the rich and famous. That doesn't make those people special just because they make a lot of money. And they're right, it doesn't. So then why are they complaining then that our society lavishes money on people that they think aren't as deserving of it morally? Right? So it's the two often don't go hand in hand. Okay, there's this thing, I don't know if it hasn't gotten a lot of attention lately, but for a while, certainly when I was writing this book, there was a big deal about what was called golden parachutes for CEOs. And what that phrase means is that a CEO would get fired for poor performance, right? So a big company would bring in a chief executive officer. So the stockholders are the real owners of the company, and they would have a board of directors, and then the board of directors would bring in a CEO to run the company. So make sure you understand that. The CEO is not the final person in charge of the company. Ultimately, the CEO can be fired by the owners, the shareholders, ultimately, okay? Because they're the real bosses. They own the company. They make those decisions. All right, so the CEO is an employee, albeit a very highly paid employee, perhaps. And so what would happen is there were these cases where a CEO had a really big compensation package where the base salary and so forth was millions of dollars, perhaps. And then, even though like the company's stock was falling and or their revenue forecasts were being missed, And so the shareholders would fire the guy or the girl or the woman, I should say, right? But yet there was a really generous termination package where the CEO, even though, let's say as a guy, even though he got fired for bad performance, would end up getting a severance package of like, $500,000 plus a bunch of stock options or something like that. And so people were really outraged that what the heck, these CEOs, they get paid millions of dollars if they do a good job, but then even if they do a bad job, they get paid a bunch of money. So it seems like it's just a system designed for rich people to give favors to their buddies, and the little guy, the people actually doing the work in the company, get screwed. That's the idea. So what I walked through is the logic of those sorts of packages. And so you have to understand when you're going to, especially if like there's a company where the shareholders wanted to go into an untested region, like maybe it's in the tech sector and it's really competitive and everybody in this field knows there's going to be some innovations over the next few years, and whoever figures the market out first and figures out how the consumers are going to use this new technology, that those people are going to make hundreds of millions of dollars if they get there first. And they all, the competitors in this field are all grappling with each other, trying to figure out exactly how are we going to innovate in this new realm, and it's not clear. And so different companies bring in different CEOs with their own visions as to what to do, and the shareholders want the CEOs to take risks because they know if we guess right and we get into this new area first, it'd be like the people who first figured out the internet or something, or the people who first figured out home computers. Okay, that the people who get there first are going to make a boatload of money. And so they don't want the CEO to be really conservative. They might want the CEO to take risks and to just go for it. And so if that's the behavior you want, you don't want the compensation package to say, so long as we're hitting moderate growth targets, you stay and you get a base salary of $1 million a year. But if you screw up and the stock price tanks, we're going to fire you and you're not going to get anything. You're going to get zero, because then the CEO is going to be timid. He's not going to want to stick his neck. He's going to not take big chances. He's going to want to just play it safe and keep the company doing fairly well compared to their peers. Okay, so if that's not the behavior you want the CEO to get a huge payoff if things go well. So you give him like a bunch of stock options that are worth a lot if the stock price goes up. But even if he's going to get fired, then there could be a clause in there saying you do get a lower amount, just as a termination package. And so that makes the CEO willing to take a big risk because he or she knows it's not going to be just a huge drop in income if they take a chance and it blows up. Okay, so that's kind of the logic behind why those things would make sense. And ultimately, you have to ask, look, the shareholders aren't stupid. They can think through the logic of their compensation packages more than the English professor who reads the newspaper and says, that's stupid, and throws the paper aside as he goes and brews some more tea. By the way, I drink tea. I got nothing against people drinking tea. Okay, so that's the stuff with a lot of these things. It's really annoying how quickly the critic will just assume all these people in the market are foolishly throwing around millions of dollars, and that he, the outside critic, thinking about the issue for 5 seconds, is more concerned about their money than they are, rather than being curious and saying, this is a puzzle. On the surface, that seems odd that you would pay someone a bunch of money even though he drove your stock price down. Let's think through and try to answer this puzzle, right? Like biologists, evolutionary biologists, if there's something that at first doesn't seem to make sense, they don't just say, that's because evolution is stupid. No, they sit there and try to figure out, is there some hypothesis, is there some mechanism by which this seemingly maladaptive behavior actually does allow those genes to proliferate, and they'll try to figure that out. And so same thing here. If you see something, a practice on the market that's odd, try to figure out what could justify it, or look for a government regulation that allows it to persist. Okay, let me skip ahead here. Okay, let me just end on this slide, and then I'll turn it over to your questions in the remaining 9 minutes or so. Okay, so here, what I want to just go over very quickly is anti-discrimination laws seem to be great, right? It seems like how could anybody possibly oppose that unless you had some quaint view of what the role of government is. But surely nobody could object to the consequences of the government making it illegal for, let's say, an employer to discriminate against employees on the basis of race or sex or things like that. Okay, so let me just walk you through why actually it's not so obvious that you would want government to dabble in these areas. Okay, so first of all, is it really right that we don't want employers to discriminate? And so you have to ask yourself, well, what do we mean by that? So, for example, if there's going to be if there's a casting director filling positions for a movie, and the movie calls for someone to play, let's say, Eleanor Roosevelt. So it's a historical film involving FDR, and then so they need someone to play Eleanor Roosevelt, and let's say Dustin Hoffman comes in to the set with the script and he's ready to read for the role. He wants to be Eleanor Roosevelt. You can imagine the director saying, Dustin, you're a fabulous actor, but this role really needs to be played by a woman. And Dustin Hoffman says, oh, I can play a woman. I was in Tootsie. I'm fabulous. I can play a woman. Don't discriminate against me just because I'm a man. That's crazy. Are you telling me that a requirement for this job is to be a woman? That's discrimination. Okay, so you can see, well, all right, that's not what we mean. When we say we don't want there to be gender discrimination in the marketplace, we don't mean something like that. Okay, well, what about when you say an employer shouldn't be able to hire someone based on looks, right? Doesn't that seem like you don't want to deny someone a job because the person's not attractive? That, at first, that sounds like a pretty reasonable requirement, right? But is that actually what you want? Do you want to go to a restaurant and have the person greeting you be really ugly? Do you notice that in practice that's not the case? Generally speaking, if you're going to take, let's say you're back in high school and you have to take somebody to the prom, would you want to be told the person that's going to go with you to the prom is a hostess or a host at TGI Fridays who greets the people when they first walk in the door and maybe gives them the menus and walks into the table? Or would you want somebody who works in the dish room? If you didn't know I have any more information, I'm pretty sure we all know what we would pick. Okay, and so the question is that a horrible thing? Or is that actually, that's not actually that bad. That's okay. And so you start going through things like that. And you see, ultimately, really what you probably mean when you say, I don't think employers ought to discriminate against people, what you mean is, if the characteristic in question really has no impact on job performance. So what you mean is things like, if an employer is hiring somebody to do the accounting, then I don't want the employer to discriminate against somebody because he's a different religion or because he's a different race or because it's a man or a woman. That doing accounting, that those characteristics that I just went through really aren't relevant. Whereas they could be relevant in some of the other areas we could imagine, but not for accounting. Okay, so that's what you mean, probably. And the point that I develop in the book is to say, well, guess what? That's exactly what the market would penalize you for. If you're an employer and you have two equally qualified candidates in all respects, except one has some characteristic that you don't like let's say one's black and one's white, and you're a racist, and they're equally qualified, and you prefer the white candidate, well, then you're costing your firm money, okay? Because if other people are doing that, if in general that's the tendency, then that means the black worker is earning less because of that racism. And so that means he's cheaper. So if they really are equal workers in terms of money, then the market penalizes you for going with the white worker, if that's what the numbers are. Okay, so that's just one example. So the point is, the market itself has built-in penalties for what we really mean by bad discrimination. Okay, and the more egregious your choice, the bigger the penalty, right? So if you have two candidates and one guy is a phenomenal accountant and the other guy is your brother-in-law and he's terrible, and you hire your brother-in-law because of nepotism, well, then you cost yourself a lot of money because you're picking the guy who's a terrible accountant over the guy who's really good. Okay, so whereas if they're pretty close and you go with your brother-in-law, well, then that's not as big of a lapse in judgment because we just said they're pretty close, and so you're actually not costing your company that much money. Okay, so that's the logic of it. Okay, like I said, I went way longer today than normally I will on these, and that was because of the upfront intro. Okay, so how do I get out of here? So, Matt, if you want to do whatever you got to do.
All right, I think that was an excellent first lecture. We'll go to Q&A now. If you'd like to ask a question, you can ask in text in the questions tab on the right, or if you'd like to ask on video, you can click video chatting above the chat window and then click start your webcam and I'll be able to bring you on screen. Our first question is from Guillermo Borrego. He asks, how much influence did the government have in developing?
Okay, that's a good question, Guillermo. I don't know off the top of my head the exact history of that. I mean, so I am aware that there were military contracts and there were precursors to the World Wide Web that it certainly helped those entrepreneurs. We're probably going to cover this sort of issue a little bit later, but just to anticipate that, the fact that government does something doesn't mean therefore it was good, right? So, for example, if the government builds a sports stadium that the market would not have built, it's true the people going to that sports stadium get a bunch of services and enjoyments that they would not have gotten had the government not helped with the funding of that stadium. So that's true, but then there's always what's seen and what is not seen. Okay, so even if it's true, let me put it this way. It's possible that had there been a much smaller government, because the thing is, if you're gonna like alter the timeline and say suppose the military hadn't spent that money on that research to the precursors to what's now the World Wide Web and the internet and so forth, does that mean we wouldn't have the internet? Well, no. Eventually, the internet would have been discovered. Through private means. It's not like we would have for the rest of eternity never had it, but it's possible that it would have been delayed. But then the issue is, well, wait a minute. What is the government doing with that money instead? If they're cutting taxes, and that's what you're doing in the alternate timeline, well, then maybe private entrepreneurs would have discovered it earlier. And also, there probably were a bunch of regulations and prohibitions in place because of the military with secrecy and things like that preventing it. So, for example, it's true that the government sent the mission to the moon, but and those resources, I think, were used improperly. Given the structure of the economy back then, I think that was a huge waste of resources to go put a U.S. flag on the moon and take back some rocks. Those resources could have been better used for more mundane things like making diapers for babies and stuff like that we wouldn't remember nowadays, but would have been more important back then to those people. But also, if there weren't the military-industrial complex and there weren't all sorts of limits on private rockets, then I think humans would have gotten to the moon and set up a moon base by now had the government not been so big. So there's that kind of issue too.
For not knowing much about the details of that was a great answer. Tiffany Madison asks, why is Bob Murphy the best ever?
Because of government intervention. If it weren't for the government, there would be lots of people that would be way better than me.
All right, while we wait for some more questions to filter in, I guess you just explained things so well. Oh, actually, and here they are. Dick Clark, whose name apparently offends eProf, asks, do you have to practice timing with delivery of your jokes, or are you just naturally funny?
Well, thank you. I appreciate that, Richard. It's developed over time, and what I do is I like using deadpan jokes, as you guys may have noticed. And the benefit of that is if the joke bombs, you just keep going as if you hadn't been making a joke, right? So it's like a built-in safety mechanism.
Or you can take the David Gordon route and say, that was supposed to be a joke. Uh, Pierre
Yeah.
Leframboise asks,
Stuff involving the Holocaust, yeah, definitely. That better be a joke or you're in trouble.
many of these fallacies stem from emotional reactions and not logic. Besides just presenting the facts, how can one better appeal towards, and the question cuts it off there, but I think he's saying, how can one better appeal towards those who are using emotion to kind of form their opinions on these things?
Okay. And by the way, I'm sorry, guys, I keep sniffling. I should have had Kleenex next to me. I forgot. Um, well, yeah, that's the thing, and I think that's a great point that you bring up. Is that it's the problem here is not really one of facts. I mean, it is in the sense that the people they do ultimately they are misinformed about how the world works objectively, so they don't understand cause and effect. But the questioner is correct that what's driving that confusion is the fact that there's not a disinterested search for causal relations, but just this overwhelming emotional concern and the desire to help people without taking too much time to analyze through. Now, some people are really cynical, and I guess I don't know. I'm not sure what the real answer is in terms of percentages. That some people are real cynical and would say, no, you're being naive, Murphy. It's actually not the case that all these people who vote for politicians who are going to, spend money on welfare checks and blah, 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 and set up schools and whatever, it's not that they actually are just misinformed and think that that's helping. They just want to feel like they've done their part. And so don't expect them. Of course, they're not going to be persuaded because they deep down, they don't actually care whether the stuff works. They just want to feel good about the fact that they have, checked the box and yep, I'm a good person. I've done what my social group says is the right thing to do. I've gone to the local fundraiser and written a check for 1% of my income, and so I'm going to go off to another cocktail. But so, yeah, that's probably true. There are probably some people like that, but nonetheless, I think it's got to be the case that the reason the government can get away and the reason politicians can say applause lines that would make most of us cringe and say, "Oh, come on, I can't believe that they got away with that." It's because the most members of the public really do believe in these fallacies. So I guess to answer the question, the way to come across is perhaps try to show that really you do care about these issues. So it's not that actually you don't care about poor people. All right. And in that respect, perhaps the tone of this particular book isn't going to appeal to somebody of that mindset.
Something about you just brings out either the worst or the best in this audience because they all want to be comedians. I've got 8 questions here and 5 of them are jokes. Shane Riddle asks, how would the economy differ in an anarchist society compared to what we have?
Okay. Oh, by the way, I probably should have made it clear to you guys. If you want, in the Q&A sessions, and especially going forward, if you want to have like the crazy out there anarchy questions, that would make sense because I'm in this book, I'm not going to hit that stuff, and so it would make sense to do in the Q&A. Okay, so the question was, how would an anarchist economy differ? Was that what it was?
The economy in an anarchist society, okay. How would it be different from?
I mean, it's hard to even imagine. Well, first of all, it depends how many people we have, right? So if it's just me and Dick Clark, and we're in a state of anarchy, that's going to be awesome, but we're not going to be able to have a military defending us from the Soviet Union and from the United States of America, right? But if you had like the current geographical United States or continental United States, and all those people were in a state of Rothbardian anarchy, well, then that would be amazing. And I'm not exaggerating when I say there would be moon bases and things. I mean, it's hard to even quantify. I mean, just back of the envelope calculations. Like I did a thing recently for Econ Lib where I just went through and found $1 trillion of wealth that minor little tweaks, the U.S. federal government could sell off various stuff that it's sitting on and raise $1 trillion. Okay, Okay, so I'm not talking about like getting rid of the income tax and all the wealth that would generate. I mean, just the federal government is sitting on $1 trillion worth of stuff that it's not really using, and so just right there, that's $1 trillion extra dollars that would be in the hands of U.S. citizens. So it's really hard to imagine. First of all, we would have a hard money, and so there would be no threat of inflation. So for all the benefits flowing from having a stable currency, you would have that. You would have a region where people around the world could flee to and be free, and not, so anybody who's in the middle of civil wars and stuff like that could get there. And you'd say, well, how would they get there? Well, there'd be companies that would rise up to bring those people there, because it would be like a magical kingdom where everybody's labor power suddenly got multiplied by 50. And not 50%, a factor of 50. Somebody in Africa right now, if they came to an anarcho-capitalist region, they would easily be 50 times more productive. And so would it be worth a company to go get those people and bring them in? Of course it would. Just like it would be worth a company to go get a bunch of barrels of crude oil, or to go get a bunch of hammers and bring them in if there was a construction project and they didn't have hammers, right? So human labor is very productive, and so it makes sense for that to flow in. So anyway, it's hard to even quantify how much richer that would be, because all the stuff we complain about the government would not be true.
New York Times tomorrow. Robert Murphy, economist, it compares Africans to crude oil.
Yeah, Robert Murphy says an anarchist society would go get Africans and bring them to do the labor in his ideal world. Yep.
I'm not even going to try it with the name, but what is your opinion on peak oil theory?
Okay. Generally, I don't think it's true. So for people who don't know, peak oil theory says that at some point, and they had specific projections, total world production of oil is going to peak and then presumably at some point decline. And I just wasn't convinced by that. The reason that it gained currency is I think that they did make an accurate prediction for the U.S. at least for a while, right? So early on they made a prediction for when U.S. oil output would peak and then decline, and they were pretty close. And so people thought, oh, this guy knows what he's talking about. But depending on if you include the stuff with hydraulic fracturing and whatever, that's no longer true. And I mean, 20 years ago, if you had said, do you think the U.S. is ever going to overtake Saudi Arabia in the production of oil, people would have said you're crazy, but that's happening. All right, so I don't know if you guys know that, but go Google U.S. world leader oil output, and you'll see that these trends. And just more generally, the United States is sitting on centuries worth of coal and natural gas and crude oil, in terms of how much are we using annually versus how much do they know is there.
Joseph Fetz asks, can you elaborate a bit upon why people say things like the debt doesn't matter because we owe it to ourselves? Why are they wrong?
Hey, Joe, let me defer that one, because I do explicitly cover that in one of these chapters, and that's the kind of thing where I'd want to take the time to set it up. So let's defer that. I'll cover that more formally, and then in that session, if you want in the Q&A, push me. I can do that, but that's not something we should tackle right now. If people just can't wait, you can go Google Robert Murphy. Debt doesn't hurt our grandkids. It just ain't so, or something like that. It was a Freeman article where I walked through it, but it would take me 10 minutes to do that justice.
MK Lords asks, does Austrian economics have an answer to any of the economic fallacies about Bitcoin?
Well, unfortunately, as you know, Ms. Lords, I think, unfortunately, some of the fallacies about Bitcoin are being generated by Austrian economics. And so for people who want to read more, if you Google Robert Murphy, the economics of Bitcoin, you can see more of this. But very briefly, the way that Austrian economists explain the origin of money and the purchasing power of money today they tied it back historically to when goods emerged out of a state of barter where they had been used as just normal commodities. And then for various reasons, some of those commodities were more marketable or more liquid than other ones, and they naturally just their liquidity snowballed until they became generally accepted. And that's what money is. It's a commodity that's generally accepted in exchange. And so that was a great explanation, and I still think historically that is what happened with all the money in use before Bitcoin. But the question is, does that story apply to Bitcoin? And it's not obvious if it does or not. At the very least, it has challenged the way Austrian economists think about that standard story. So the more I'm thinking it through, I actually think it's consistent, but it's true. It's consistent with the story in a way that I wouldn't have entertained before I saw it with my own eyes. Because I think what happened is initially, the problem is how can you accept something as a medium of exchange, as something you're going to trade away, if you don't have a sense of what its purchasing power is. And so that's why Mises and other Austrian economists said, for something to become money, it must have started out as a regular commodity so that people would have some sense of how much it was worth compared to other things. And so that's why Mises thought for something to become a medium of exchange, it had to have that history. Otherwise, how would you know? But with Bitcoin, what happened is when it first started out, it was almost worth zero, but not precisely zero. And so that's like how the genie got out of the bottle and then it mushroomed. But even there, in that first transaction, you could say, well, why did the other person take it? And I don't know, maybe the person thought it was just cool, like he wanted to have it just as a novelty, or maybe the person recognized, if this thing takes off, it could be worth a lot. And so, yeah, I'm willing to give up my pizza for whatever, 500 of these or whatever the exchange was at the time, because there's on the off chance this thing takes off. So maybe initially it was accepted purely as a speculative investment, and then as more and more people began accepting it, then it turned into a bona fide medium of exchange, and then if enough people accept it, it'll turn into money. So that's possible. As far as all the other fallacies, MK Lords, yeah, Austrian economics is better equipped than any other school of thought to knock those down. So, for example, people often say, oh, the Bitcoin's stupid because it's deflationary. Because of its finite amount, that it asymptotically approaches a certain quantity of Bitcoins and it can never inflate beyond that. That means the purchasing power of Bitcoins are going to keep going up. That means prices quoted in Bitcoin are going to keep going down. And that's going to be devastating on the economy. Why would anybody buy anything in Bitcoins if they knew they just would wait 6 months and they would be cheaper? Right? And that's silly. And Austrian economists can blow up that kind of fallacy better than most other economists who actually are worried about deflation. Whereas the Austrians were never worried about a hard money leading to falling prices. So yeah, there are a lot of fallacies that Austrian economics is very suitable for knocking them out. But unfortunately, like I say, some of the major objections to Bitcoin were coming from the way Austrians handled the origin of money.
In a bit of shameless self-promotion, I'll actually be speaking directly on that topic about the economic fallacies of Bitcoin in mid-August at the Cryptolina conference in Raleigh, North Carolina. So if you want to hear more, you can come to that.
Right.
Our next question. Say again?
I said you're right. That was shameless.
All right. Our next question is from William Berryman. He asks, "Are you involved as an investor? If so, what kind of investments do you have, if you don't mind sharing?"
You want me to share my investment with you? I'm not going to do that. You mean discuss it? Okay. My general advice to people is, and I'm trying to follow this myself. First of all, develop multiple streams of income. Okay, so get out of the mentality of thinking, oh, this is what my income, like, how can I put it? Yes, it's good to have a budget, but the problem is sometimes when people drop a monthly budget, they say, this is my income, and now I have to make sure I spend less than that number. And they take their income as just this outside fact, like, well, that's what my paycheck is after withholding and all that kind of stuff. And so this is how much I have to work with. And so I guess I can't go to Starbucks anymore because my income's not high enough. And you want to get out of that mentality that if you're having a tight budget situation, the way to fix that is to go earn more money. And it doesn't mean you quit your current job. It means figure out ways to bring in more income now. And then people say, "Oh, what should I do?" Well, I don't know. It can't be the same answer for everybody. Otherwise, it can't be true that everybody should go become a cherry farmer, because then there'd be too many cherries and the price would collapse. That would be stupid. All right. So it's not that all of you are going to go do the same thing. You got to figure out what do you have an advantage in and go do that. But the point is, you really want to figure out how to generate multiple streams of income. In general, that's a good strategy, but particularly now where I'm worried that there's going to be another crash. And as we go on, probably in the last lecture, I'll hit the stuff from the book about the business cycle, and I'll be able to briefly explain why I think that there is going to be another crash at some point. So then, okay, you boost your income, and then what? Well, save more. So as you boost your income, don't just have your consumption rise with it. Save more and more. And then what do you do with that savings? Okay, for one thing, if you have credit card debt, you got to knock that out as fast as possible, because if interest rates rise, then your APR and your credit card balances is going to go up and you're just going to get killed. I mean, probably what would happen is you would just default and it would ruin your credit score. So try to knock that out. So like if you have a credit card balance right now rolling over at 20% APR, that's like you have a guaranteed 20% return for every dollar you pay down to that. So don't invest in something else unless that other thing in your mind is better than a guaranteed 20% rate of return, or whatever your APR is and your credit card balance. So that's the way you want to think about it. Unless you just have decided, no, if there's a crash, I'm just going to default, and I don't care if Visa and MasterCard hate me. I'm just going to default, and I'm going to have gold coins. So there is that logic as well. But I'm just saying, if you're the kind of person that doesn't want to declare bankruptcy and you want to have a good credit score, and you're carrying credit card debt right now, that's a no-brainer. Get rid of that. And then beyond that, getting gold and silver, getting a few months worth of your basic expenses in terms of gold and or silver that you physically hold and hide somewhere, I think is a pretty good safety strategy. Then beyond that, what do you do? Yeah, if you're computer savvy and you want to look at Bitcoin, I imagine if there's a crash, Bitcoin's going to go through the roof again. But and there's other things too. But I don't want to say more than that, because then we start getting in the realm of real specific investments, and there's pros and cons, and it depends on your preferences. But the stuff I've said, given what I think is coming, I can't imagine anybody's going to come to me in 10 years and be pissed that he paid down his credit card balances or got several ounces worth of gold in 2014. I don't think anybody 10 years from now is going to regret that kind of a decision now.
Our next question is from Dick Clark. He asks, are you in favor of the income tax?
No. Is that one of the 5 jokes you were alluding to? No, I totally would get rid of it. Perhaps maybe you were going off of what I said earlier when I said I'm not even talking about get rid of the income tax. All I meant there was when I was trying to explain to you guys how much wealth would be generated overnight if we went to a genuinely free society. What I meant is the government right now is sitting on tangible assets worth more than $1 trillion in current market value. I'm talking about like the Strategic Petroleum Reserve, right? So the government right now owns a bunch of oil that it's buried in salt mines or salt caverns near the Gulf of Mexico. Okay, so the government's sitting on it. The government, at least it claims, owns a bunch of gold. Perhaps those vaults are all empty. The government owns a bunch of real estate, especially out in the West. That the federal government is by far the biggest owner of real estate out West. And I think if they sold that off and allowed people to come in and develop it, it wouldn't just be desert. It would be like, Lex Luthor's plan, except without sinking the western coast. Okay, so that's all I meant in case you were curious. So yeah, of course, I want to get rid of the income tax. I just meant when I was explaining how overnight the government could create all this wealth and return to the private sector, I wasn't even counting stuff like lowering taxes and then people going and producing more. Should we maybe do one more question, Matt? Because I think we're way over time at this point.
Yeah, let's do one more from Guillermo Borrego. He asks, what's your view on the economics of fractional reserve banking? Of course, you could probably go an hour on that one.
Yeah, but I'll go ahead and answer that because and since it's the last question, I'll do a few minutes on it because I don't think I would touch on this as opposed to Joe Fetz's question where I know we're going to talk on that later. This one I don't think would come up in the book, so I'll go ahead and field that one now. So as you guys probably know, fractional reserve banking means that when somebody deposits money with a commercial bank in what is called a checking account, or more formally a demand deposit, nonetheless, the bank doesn't keep 100% of that on deposit. It lends out some of it. So if I put $1,000 into my checking account, my account gets credited. So now I'm walking around thinking I have $1,000 more that I can spend, but the bank might then take 900 of that and lend it out and only keep 100 in the vault. That's the idea. So um, just about all Austrians agree that the government system right now, where it, in conjunction with the Federal Reserve, where it sort of props up banks and acts as a lender of last resort and relieves banks of their contractual obligations whenever there's a bank run or a panic, that's a bad system because it encourages banks to keep lower reserves than they otherwise would, and that's bad. And that it also and the problem is that causes credit inflation or credit expansion, because when the banks now lend out more money, there's a very legitimate sense in which the total quantity of money in the community has increased. So when I deposit my $1,000, I still think I have that $1,000. That's still in my cash balances. It's just the form has changed. Instead of being 10 $100 bills in my wallet, now it's a $1,000 balance when I put my card in the ATM and I see what my checking account balance. Now it's got $1,000 in there. So I still think I have $1,000. I'm still walking around spending that kind of money. But if the bank then gives a $900 loan to someone else, now that guy thinks he has $900. So that $900 loan is new money in the economy in a very legitimate sense. So that sets off the boom-bust cycle in standard Austrian theory. And so just about all Austrians agree that if there's too much credit expansion, that's bad and it sets up the boom-bust cycle. Where the disagreement lies is there's this group called the free bankers, and they say as long as fractional reserve banking occurs in a pure market without the government favoring fractional reserve banking and fostering it, well, then it's fine. And so my own view is I try to thread the needle on that. What I say is I think in a totally free society, what would end up happening is there would be a demand for true 100% backed money certificates, so that when you put your money in there, it was just kept in a vault, and you would have to actually pay the bank a small fee for warehousing your money, right? Because they can't lend it out and earn interest. They're just watching it for you and making ATMs available and engaging in clearinghouse operations when you write a check and that sort of stuff. So the bank has to be compensated for providing you those services, and so you'd have to somehow pay them, maybe it'd be an annual fee for the privilege of having a true 100% reserve checking account. But I don't think in practice most people would keep a lot of their wealth in that specific form. I think there would be really short-term liquid loans that you would make to the bank that would serve a lot of the functions for what today are served by so-called checking account balances that are actually fractional reserve backed. So that's my comment. I think both camps are correct insofar as what they say. The guys like Walter Block are right when they say, no, there really should be 100% reserve banking, and the banks would provide it, and some people would want that. And then the other people are right when they say, no, that's a crazy system. In practice, people don't mind knowing that they might be turned away, that actually their money might not be there for them if they're going to earn an interest return on it. They would rather it be fractionally backed and then get paid interest. And I agree with them too. And so I think in practice what would happen is people would have a very small proportion in literal 100% backed stuff, and then the rest would be in these really short-term liquid loans.
All right, well, that wraps it up for the Q&A tonight. Thank you so much, everyone, for coming. Our next session on this is not going to be next week. We're going to have a break week next week, but the 11th, the 18th, and the 25th at 9:30 p.m. Eastern, we'll be doing the remaining sessions in this economic fallacies course. We've got some great stuff coming on up this week at Liberty.me. Tomorrow night, Sheldon Richman is going to be giving the second lecture in his series on the American founding. If you missed last week, it was awesome, and you should definitely look for the recording, which will also be coming up on the site later this week. We've got Isaac Morehouse Thursday night, and next week we've got a bunch of great stuff, especially related to Bitcoin. We've got Jason King, Roger Ver, and Elizabeth Plachet all doing lectures on Bitcoin. We've got Thaddeus Russell, Peter Earle, and Jason Brennan as well. And Robert Murphy has a great event coming up also in mid-August that is going to be awesome. I think we're going to have some Liberty.me people on the ground. It's called Night of Clarity, and I'll actually let him tell you just a little bit more about it.
Okay, sure. Yeah, thanks. I forgot about that. So it's August 15th is the date. If you are within driving distance of Nashville, I'd strongly encourage you to consider it. The website is nightofclarity.com. And we got David Stockman as the headline speaker, Tom Woods, Larry Reed of the Foundation of Economic Education. I'll be giving a talk, and then Nelson Nash, who wrote the Infinite Banking Concept book. We're all going to be there Friday night, downtown Nashville. Tatiana Moroz is going to be singing and playing her guitar, and it'll be a great time. And if you haven't been there, downtown Nashville is truly awesome, and so you should come check that out as well. So it's all at nightofclarity.com, and like Matt said, some of your favorite Liberty.me personalities will be there as well.
All right, thanks so much, everyone, for coming tonight. Hope to see you in the next sessions and elsewhere at Liberty.me. Thanks so much to Dr. Murphy, and everyone have a great night. Take care.
Thanks, everybody.